I think we are ready to get started. Well, welcome everyone. My name is Jeff Gould, and I am pleased to present to you today this introduction to a fiduciary's role presented by our CCIM Los Angeles Fiduciary Committee. And just to kind of get started here, a little housekeeping. I want to go ahead and thank our fiduciary committee sponsors for being involved in our committee. And I also want to suggest to the audience that anyone, and we'll talk a little bit about how you might get involved, anyone who's interested in getting involved in our committee can do so. We'll give you the link in a bit, but also suggest that any other companies or anybody in this sector who is interested in being more involved or becoming a sponsor, please do reach out to us as well. So again, thank you to eXp Commercial, Lineage Asset Advisors, Clumex Stern, Crost, Northern Trust, and Truist Wealth for your generous sponsorship of our committee. So again, my name is Jeff Gould. I am co-chair of the Fiduciary Committee, and I am also the principal and founder of a company called Lineage Asset Advisors. Today, we're going to talk a little bit about the agenda right now. So, first and foremost, we're going to go into a little bit about who we are. We're going to give you an introduction to a fiduciary's role presented by my co-chair and partner in crime, Peter Lawson. And then we're going to go into a panel discussion, which is going to kind of evoke hopefully some interesting dialogue from the audience and from the panel around these very unique perspectives of our panelists. And so we're looking forward to having Della, Larry, and Steve discuss the unique perspectives they have on this topic. So I was going to kick off the presentation with a joke, and I tried to put in, make a funny joke about the fiduciary trustee beneficiary world in ChatGPT. And literally, there was nothing that came out. So one of the thoughts that I was going to say, what fiduciary beneficiaries and a piece of real estate walk into a bar, but nothing came forward. So I'll just hold tight there. And I'm not a comedian either, so we won't even attempt to go there. But anyways, thank you all for attending. We have a really dynamic audience, which spans many different industry sets in the real estate space. So we're looking forward to kind of just touching on these subjects today. The concept is kind of an introduction to everyone, with the concept also of us diving deeper in the future on these specific topics and pulling the strings on these topics that are related to the fiduciary and real estate worlds. So a little background on what is a CCIM. We do have a number of attendees that are either not members of CCIM Los Angeles, are not designees, or perhaps don't know anything about CCIM. So, CCIM, the institute and the organization, has been around for almost 50 years. The designation does remain the gold standard for commercial real estate professionals, including everything from appraisers to developers, investors, and lenders. And really, CCIMs do have to complete a really rigorous coursework around the concepts of financial and market analysis in the real estate space. So for anybody who is interested in getting involved in CCIM, we are an international organization. There's a lot of really great coursework and education and resources, even if you don't plan on getting the designation. So again, the CCIM Institute, which is more of the national institute, is based out of Chicago. We do deliver commercial real estate investment methodologies and tools that speed the pathway between opportunity, a no-go or go decision, which we'll talk a little bit about today, and success for a real estate asset. So each CCIM class is specifically designed to enhance the success of commercial real estate professionals. And really, this is regardless of specialty. So for anyone, our particular committee is looking to attract those that are maybe related fields, such as the estate planning fields or the wealth advisory fields, that are interested in getting a deeper dive in the commercial real estate sector. And the education that we can provide to you, I think, is really relevant. So, we have about 8,000 professionals across the board, nationally and internationally. And in Los Angeles, we also have a very dynamic chapter as well. And I think that's the subset of most audience members, as they're based in the Los Angeles or surrounding regions. So who do we serve? It's everything from investors and investment counselors all the way to brokers, and then all the way down to bankers. So we have a very dynamic list of audience members and folks that are in the commercial real estate space. And so I would encourage anybody who is involved or even on the periphery in this space to learn more about CCIM and how we can provide value. So touching on our mission at the CCIM LA Fiduciary Committee, we've had the great benefit of having one of my mentors, Carmela Ma, who is a wonderful instructor and has been involved in the CCIM Institute for many, many years. Basically launched the first fiduciary class or course at CCIM, along with Peter Lawson, who's going to be talking today. So with that, in tandem to the education that we're aiming to provide, our mission at the CCIM Los Angeles chapter of the Fiduciary Committee is to provide education, networking, and guidance around the very unique and complex topics of real estate wealth transfer and the fiduciary's role with investment real estate assets, which again, we'll talk about today. And our committee is comprised of corporate fiduciaries, private fiduciaries, family offices, real estate advisors, and also also importantly, related fields such as estate planning attorneys, CPAs, real estate attorneys, wealth advisors, and banks. Some announcements and a little bit more about what we're aiming to do for the remainder of this year and for 2024. We have launched last year or this year. Peter and Carmela launched last year, actually. I think it was last year, Peter, the Ward course. We have a wonderful list of courses, called the Ward courses at the CCIM Institute, and that's at the national level. And Peter and I will be presenting a more specific and in-depth conversation around working with fiduciaries on October 13th, 2023. And so we'll be co-presenting that presentation, and the link will be in the PowerPoint presentation that we provide to the audience. I should say also that you will get the link to the presentation as well. And what we're aiming to do for the new year is to have fiduciary-related educational webinars around specific topics, and we'll be taking a poll at the end of this presentation to see and decipher what our audience is actually interested in related to this topic of fiduciary and real estate. Networking opportunities and other related opportunities and educational opportunities that we're going to provide. So what I would encourage everyone to do, and we'll talk a little bit about that, is to get involved in our chapter and our fiduciary committee. Here's a list of our executive committee members, our executive board, and all of these professionals are very well-versed in this space and provide a very unique perspective across many different industry sets around the topic of fiduciary and real estate. And so we're excited to have this very dynamic board here to help us shape and frame the education for the coming years with our committee. And here's a link to some information to get involved, how to get involved with the CCIM Los Angeles chapter and our wonderful committee. I would encourage those who are interested in getting involved with our committee to actually become a member of CCIM Los Angeles so that you can get linked up to all the education and topics that we're covering, which is even outside of this fiduciary topic. So before we launch into this discussion, my personal background and my company, we provide succession planning solutions for multi-generational real estate families. And I think what's interesting about the market opportunity that we're talking about today is we're talking about the current picture of this wave of wealth transfer that we're seeing and we're going to realize over the course of the next at least 10 years. And this is I think this infographic from Visual Capitalist really depicts what the market opportunity is and how substantial it is. So if you look at the $156 trillion in US assets that are going to transition, this pie chart breaks it up by generation. And if we look at the generation where the most substantial amount of real estate is situated, it's with the baby boomer generation, about $18.3 trillion. And so we are about to realize a very substantial wave of real estate wealth transfer. And I know we've been talking about it, but it is coming at a very fast pace. And so us as stewards, as real estate advisors, how can we be good advisors, good stewards to not only the families to help them plan for this transition with real estate assets, but also to the fiduciaries who are going to end up inheriting and managing these real estate portfolios. So I just thought this was a really nice entree into our discussion. So I want to introduce my partner in crime as someone who is an expert in this space, and Peter Lawson is going to give us an introductory presentation and just touch on these topics, which will launch us into the panel discussion. And just a little background on Peter: he's a retired real estate asset and property management professional who's garnered skills and experience over nearly 40 years working for 2 major US banks and a Beverly Hills-based real estate investment company. During his professional career, Peter earned the designations of CPM, CCIM, and CIPS to enhance his skills and capabilities to better serve the numerous private trusts, high net worth families, and charitable foundation clients in the dynamics of managing investment real estate holdings. And so I won't go into all the details. Everyone else can read the slide, but I want to introduce Peter into the conversation and have you kick off our introductory presentation. Take it away, Peter.
Thank you, Jeff. Appreciate your introduction, and good morning, everyone. It is indeed a pleasure to be here, and we thank your attendance and interest in this subject. As Jeff has indicated, my portion of today's presentation will really be a very cursory, light overview, just to give you somewhat of a foundation of the issues that our distinguished panel will be talking about it a little bit later. So you're understanding the focus that we are attempting to share with you today. And again, as Jeff has indicated, if you're interested in learning more about this field, either as one who is already in it and wants to garner the additional insight on the role of fiduciaries in real estate, please do consider signing up for the October 13th course. So without further ado, very briefly, the term fiduciary means an individual or an organization who has the legal responsibilities to act on behalf of the very best interest of what would be designated as beneficiaries of the trust. And again, there are many levels of beneficiaries, but the primary focus is this duty to another entity. Consequently, these fiduciaries must adhere to a high, if not the highest, ethical and moral standards in managing all of the assets. And our focus again today is on real estate, pursuant to the terms of the trust document, which we could also consider the governing document, for the stated objectives of the benefits for the various beneficiaries. Fiduciaries should are most often chosen based on the particular expertise and integrity and ability of what that fiduciary can bring to the table to fulfill their goal of benefiting all of the interests in the trust document. So in understanding trusts, the trust, or as I said a moment ago, the governing document, is a legal entity or arrangement that allows assets, including real estate, to be transferred into that ownership entity and managed for the benefit of the beneficiaries. They're managed by the fiduciaries, most often in our world called trustees, who have that legal duty to manage all of the assets in the very best interest of the designated beneficiaries pursuant to the guidelines of that governing document. Trusts are often used to manage real estate assets for the benefit of family members or other designated beneficiaries. For today, we're going to focus mostly on 2 basic trust types, the revocable and the irrevocable. A revocable trust is most often established by what we would call the grantors. In California, it's more common to refer to them as the trustors, who set up a document for the management of the assets that they will transfer and again, most often it's during the remaining of their lifetime. And then they, as the trustors, would have the power to amend or revoke the trust. That's why it's referred to as revocable. However, upon the death of the last grantor, let's just pick one scenario for the purpose of understanding, but there are many. You may have two individuals who are spouses. They establish a trust for the benefit of their assets and themselves. Spouse one passes away. Most often the remaining spouse is the beneficiary. Spouse two, spouse or partner, number two, pass away. Then the trust is, if not designated to be closed, becomes an irrevocable trust pursuant to the direction of these trustors for the benefit of new beneficiaries. They may be children, they may be charities, they could be any number of entities, but it is now irrevocable in most cases because those trustors have passed away and they were the ones that were really given the power to make any changes pursuant to changes in their lives or their objectives. There are some exceptions, most notably a court, under the proper circumstances, can make alterations. We can teach you more about that in the upcoming course. So, in planning for wealth transfer with real estate, high net worth families with a significant real estate portfolio will most often want to develop a transition plan to ensure the continued success of their hard-earned real estate investments and preserve a legacy for future generations. Transition plans often help families to define what their goals and objectives are for the real estate, identify the potential risks which are inevitable in any sort of asset holding, and develop the best strategies to manage, mitigate, or work around those inherent risks, again, for the benefit of the next generation of beneficiaries. Without a transition plan in place, real estate families could risk losing control of their investments, facing potential legal challenges, and damaging relationships for the future generations. Just recently in the news, you've probably seen some articles about some very high-profile politicians who are now involved in wealth transfer struggles of real estate because it appears that they didn't do adequate planning when they should have some time ago. So how does one select a fiduciary or trustee who's going to take on this extremely important responsibility? Because they have to ensure that the assets are managed in the best possible way, as we're showing here on this slide, and to preserve the growth and value, and also future income. Valuable expertise and knowledge is what can help these families achieve that goal. And then, as we'll talk about a little bit longer, it's a team of various professionals that are going to have that input to give the knowledge. As Carmela and I have always said, knowledge is power, to give the fiduciaries and the fiduciary team the best opportunity to succeed at achieving those goals, mitigate the risks, have appropriate and effective management, deal with the inevitable market fluctuations. Heaven knows we've seen that in the last couple of years, legal challenges, and all of the intricacies that go into managing real estate as successfully as possible. So let's just start with, why did we say in this class how to work for fiduciaries? It's a big world. Well, statistically, it's very difficult to come up with an exact number of how much is held in fiduciary accounts. But we do have this indication from 2020 of US corporate entities that at that time, and you will all recognize the names that we've designated here, from Morgan Stanley, B of A, Northern Trust, Wells Fargo. A quick addition of these numbers will show you that at that time, there was somewhere in excess of $5 trillion held by US corporate entities, and this is both real estate and non-real estate, for management in a fiduciary relationship. So now we see fiduciaries, our trustees, and what they're dealing with. What are some of the basic duties that they must always adhere to? Well, they have a legal duty of loyalty, care, and diligence to manage real estate and all of the assets on behalf of the trust in adherence with the trust guidelines, and they must act in the best interest of the beneficiaries pursuant to that trust guideline and the document, and ensure that they avoid even the semblance of conflict of interest. Breaching a fiduciary duty can be devastating and result in very high legal and financial liability from beneficiaries against a fiduciary or even other entities. So step one, as we are beginning to show you in this world, it's the duty of loyalty. The fiduciary must be loyal to the trust and the trust guidelines and the beneficiaries. They must avoid, as I said, the conflicts of interest and refrain from any self-dealing. And the fiduciaries must act with total integrity and honesty in managing the real estate and all of the assets. That duty of loyalty is further enhanced by the duty of care or responsibility in the actions that they take. So it's to manage the real estate to the highest degree of prudence. They must make informed decisions and consider all relevant factors and document their consideration of those factors when they make decisions on how to manage the real estate. They must ensure that the trust assets are always well maintained to the best ability of the trust and the resources available, and that they generate fair and appropriate income and future appreciation. After loyalty and care, it's the duty to inform. The duty to inform requires fiduciaries to provide accurate and timely information to the beneficiaries. Again, most often the duty of communication is designated within the trust document. The fiduciaries have the duty to communicate that appropriate information to the appropriate individuals or entities that hold an interest in the real estate, the outcome or success of the real estate, and or any changes that may involve the real estate or non-real estate assets. Part of that important duty to keep beneficiaries informed is the duty of proper and sufficient accounting. So accounting and timely information on statements, returns, and again, we have several experts here that will deal a little bit more on the details of that, is paramount in fulfilling these duties of care, of loyalty, and responsibility. And they must provide transparent and detailed appropriate accounting of the assets, including and often even more so for the real estate. Managing real estate. Well, any of us in the real estate field, or all of us, I should say, know that managing real estate is quite a responsibility. The fiduciary has the highest degree of maintaining that asset in a balanced and appropriate manner for the income, the appreciation, and the protection of risks. The fiduciary has to make, as I said earlier, informed decisions about real estate investments and consider the long-term interests of all parties, including beneficiaries. And we'll be building upon this theme for the importance of having a fiduciary supported by all the professionals who in themselves have a fiduciary responsibility to achieve these goals of care and management. So who would be members of this fiduciary team? Well, besides the trustee, most often an attorney for the trust. When it has to do with real estate, a trusted real estate broker and agent will be able to perform the various responsibilities such as leasing or sale or acquisition. The critical team of an asset and property manager, those individuals that are responsible for making sure that while a real estate asset is held in the trust or in the fiduciary team, it is managed both on the asset and day-to-day property management level in the best possible manner. The accountant, usually the first level of making sure that information and accounting is properly documented and made available to the appropriate entities. The appraisers, who will help this team keep track of the valuation fluctuations that are going to happen in real estate in good and not so good times. Trusted contractors who you know can do the best to maintain the property for long-term capital improvements, as well as preparation for leasing or other ongoing responsibilities of what makes that property a financial success. Financial advisors often come in relative to helping the team understand how to manage non-real estate assets so that there are the appropriate funds to maintain the real estate. And of course, last, the trustee or fiduciary in the case of this particular presentation, we're considering them synonymous. Investing in trust funds, well, of course, it has to be done prudently, and there has to be appropriate diversification of investments. They must consider the risks and return of real estate investments and ensure that investments align with the trust goals. I remember when I started in this business, there used to be some sort of a little competition between the real estate professionals and the non-real estate asset management liquid professionals. And really what we've learned over the years that they should be partners because one really needs the other, and that good communication between the real estate professionals and the non-real estate professionals so that all assets who are inevitably interdependent on each other are managed to the highest and best degree. Okay, fiduciaries, pretty big job, pretty big responsibility. Well, with that responsibility and the reward of hopefully success comes some very serious issues that must be recognized. The conflicts of interest, breach of duty, or failure to communicate could have significant consequences to the fiduciary, whether it be an individual or a corporate entity, legal liability, fines, damage to its reputation, of resulting in any sort of these breaches or failures of duties. So they have to act proactively to manage the risk and implement the best practices, both for the beneficiaries and for themselves. Failure to succeed or adhere to these highest standards could be catastrophic for a fiduciary. Some of the best practices, well, we've touched upon them already. It's just adhere to that responsibility of loyalty and care to the highest degree. Documentation on decision-making for all the assets, including the real estate. Why did we decide to sell this asset? Or maybe go into an exchange or put in a capital improvement. Documentation, and in case you need a third reason, more documentation. Fiduciaries should communicate regularly with the beneficiaries and provide them with timely and accurate information. There are many nuances to this, but in many cases, it's providing accurate statements on the account, whether it be monthly, quarterly, annually, whatever that trust document has designated. And fiduciaries should never hesitate to seek professional advice from the appropriate third parties, be it the attorneys, the accountants or real estate professionals to help them meet those best practices. So in conclusion, the fiduciary duties are critical in successful management of the real estate to achieve that goal for the beneficiaries pursuant to the trust document. They have to abide by legal and ethical principles to fulfill those and avoid the risk of legal liability. Fiduciary duties are critical in managing real estate, and following these best practices and implementing risk management can help those fiduciaries effectively manage the real estate for the trusts. So I think we're ready to delve a little bit more into that. So Jeff, back to you.
Thank you, Peter. Appreciate it. And it really does give us a nice taste test into this world. And I think many of those that I work with, multi-generational families, those that are in the audience, many people will get designated as a successor trustee, either a private trustee or you might be a co-trustee. And I think these topics are critically important to delve into, specifically around the responsibilities of real estate and how us as advisors and you as a trustee or fiduciary can appropriately manage and leverage your resources, because it is a very serious role to play on behalf of these trusts. So thank you, Peter. I'll ask our panelists to rejoin us now to share your video, and also go off mute here. I think, Steve, we just need you to do that as well. So as we launch into this, I want to introduce our panelists. And so I'm going to go into the brief bios of each of the panelists, and we'll get started with a nice fluid panel discussion around this topic and try to dive deeper into the unique perspectives that each of our superstar panelists has on this topic. So with that, I'd like to first introduce and give the bio on Della Ram Pekar, or Della for short. Della is dedicated to devising effective and tax-efficient strategies for transferring wealth to charitable organizations, family members, and future generations. She caters to individuals, families, and closely held businesses with connections across the globe, with a particular focus on California and the United States. Della also provides guidance on a range of conventional wealth planning instruments with a comprehensive approach that aims to reduce federal, state, international, and local tax liabilities. And Della, her ultimate goal is to help clients achieve fulfilling and productive lives, contribute to philanthropic endeavors, and raise competent and responsible children. So Della is our estate planning attorney perspective from Venable. So welcome, Della. Our next presenter panelist today is Larry Klumek, who is an accountant and actually holds many different roles, which we'll talk a little bit about as well. He's an accountant, a private trustee, and a real estate investor himself. He's a founding member of Klumek, Stern, Schenkelberg, and Getzoff, and has been engaged in public accounting since 1975, since before I was born. Thank you, Larry. Larry's 40 plus years of experience include specialization in the areas of estate planning, estate and gift taxation, individual and business tax planning. His expertise includes everything from accounting, auditing, consulting services, and business management for a widely diversified group of commercial, service, nonprofit, and individual clients. He's also an experience in litigation support services, including expert witness testimony, court accounting, business valuations, cash availability analysis, and tax analysis regarding structuring of property settlements. Larry is also fluent in French. So I will let everyone else read the remainder of Larry's bio, which is very impressive. And we'll launch into Steve. Steve, are you able to share your video and your screen with us and go off mute? Or did we lose Steve? Hopefully not. Okay. So Steve is the leader of the commercial real estate practice at Northern Trust and is a senior vice president in Northern Trust's Los Angeles office. Northern Trust's national real estate portfolio is valued in excess of $2.5 billion and encompasses approximately 1,600 real estate interests, which are owned by family offices, institutional investors, and various types of trusts and investment entities. Steve and I have also known each other for a while. He oversees a team of 8 individuals performing hands-on asset management and hundreds of direct owned real estate investments, as well as advising Northern Trust's clients on real estate investing strategies, acquisitions, dispositions, and financing transactions. Over his career, he's worked on and completed about 8.5 million square feet of properties with a value of over 2.7 billion. So that's Steve Todd. So with that, I'd like to launch into our discussion and start kind of delving into this world and the unique perspectives that each of our superstar panelists has on this topic. So I'd like to start off with Della and kick it off to you. First question is, as an estate planning attorney that plans and helps these families with substantial real estate holdings, you play a critical role with clients in selecting and working with fiduciaries specifically. So from your perspective, what are some key considerations from an estate planning perspective that you can share with the audience when it comes to planning with families that own real estate? And particularly if I want you to key in on the topics of selecting and working with fiduciaries.
Yeah, definitely. First, Jeff, Peter, I just want to give you guys a big shout out. I know you guys have been putting this together for months now, and the whole presentation has been flawless and fantastic, and it's been a joy to work with you and get to know everybody on the panel too. Regarding the question, so the great thing about estate planning is that if you have the clients who come ahead of time, the prepared clients, and you have the clients who give these things some thoughts, you can actually have a very good comprehensive plan set out way in advance of anything happening to you or your family. And in the case of real estate, we have the options to really set out what the goals are and what that grantor wishes to do with that portfolio. So special considerations generally that I talk to when I know my clients are specifically real estate heavy is first and foremost, really it's the family dynamics and it's the emotional attachments to these properties. What's unique about real estate, and that doesn't necessarily happen with stocks or other type of liquid assets, is that, of course, we get some sort of attachment to those properties. And sometimes those attachments they contradict what the fiduciary duty is, which is to grow the assets, to leverage those assets. But at the end of the day, you could be like, I don't care about that. I want that house to be ours forever, for example. So one thing that you want to make sure you handle from my side and to really speak to the clients about is, okay, we want to make sure that this portfolio is liquid enough to support such kind of attachments, to understand those assets that have special values to our clients, and then to be able to leverage other properties that they might not have that same emotional connection with. And that plays a lot with how we communicate that to those beneficiaries. You want to make sure that your plans really clearly state certain intents and don't cause unnecessary uncertainty when the grantor is no longer with us. Other things that I really want to make sure my clients are aware of is property management. Of course, there's a lot of responsibility that comes when it has to deal with the real estate, and the fiduciary and whoever is supposed to be handling these has to have some sort of comprehension on managing, especially income properties. That ties in a lot with understanding taxes and getting, collaborating with tax experts, getting their involvement so that we can do a great job of passing real estate to the next generation without having to, sell assets that maybe the grantor really doesn't want to have that kind of thing happening. And then, of course, with that is the whole idea of succession planning. A comprehensive plan does a well job of explaining and managing the real estate assets for the future. And of course, as we're dealing with right now, we know the economy changes, the interest rates changes, and with those, the way you plan changes as well. So you have to have plans that are flexible to accommodate things like that. And these are things that we want to make sure in a trust, they're really clearly written out, clearly explained, communicated to all parties. And I can't emphasize that enough. Everybody thinks that their family, is going to get along and, stay one huge unit even after they pass away. And the number of times I've seen that not be the case, I can't even count them. So having that type of clear, defined understanding and communication with your beneficiaries has been critical, especially with real estate, where in many cases, once the original grantor passes away, now all of a sudden you might have multiple owners of the same property. So you really want to make sure that they're all on the same page. There's some sort of hierarchy. There's some sort of plan as to how we're going to discuss conflict. All of these is something that a trust, as a trust, you should have them written out. And as a trustee, you should be aware of when you are helping in these situations.
Awesome. Thank you, Della. And that planning doesn't happen overnight, as everyone knows.
It doesn't. And it has to be flexible enough to change. Oftentimes you have clients who come and go, and things like the economy picks up or takes a turn for the worse. And you don't want to be stuck in a situation where you can't change for that.
Excellent. Excellent. All good advice. So I want to jump over to Larry. Larry, you have a unique perspective. As I talked about, you have a perspective from the accounting world, private trustee world, and as a real estate investor. I want you to specifically, first and foremost, from your accounting, putting your accounting hat on, can you share with the audience the important role that you play as an accountant in helping your real estate clients look at succession planning and selecting and working with fiduciaries as well?
Sure. Well, first of all, thank you. And thanks for asking me to be part of this panel. Yes, I look at things from a different perspective, depending on which hat I'm wearing. But from an accountant standpoint and helping clients determine what the best course of action is in a selection of trustee and how to manage property, Della covered a lot of the issues that come up. And I think as a CPA and an attorney, we usually work hand in hand in planning these things and making sure that the client expectation, the grantor expectation are maintained and take into account what is all transpiring. One of the roles we do play is we're involved in much of the income tax aspect, income tax return preparation. We're involved on the private side when there are private trustees in court accounting reporting. Peter talked about the transparency and communicating with the beneficiaries. And so court accountings are very different accounting than general a profit and loss statement and balance sheet. Beneficiary get an opportunity to see each and every transaction, and likewise they get the opportunity to question each and every transaction if they have questions or if they have doubts. And so we help in communicating a lot of the information that a trustee is obligated to communicate to the beneficiaries. And we also help plan in succession what is going to happen with items such as real estate. Della touched upon the fact that there is an emotional attachment to certain property that may not, that the grantor may not want to get rid of. And frankly, my involvement in that discussion is to advise the client as to why maybe that emotional attachment is not in the best interest of the succession for the family, and try to detach them if necessary. If most of the time people think they're keeping this dynasty going and they want to keep what they've created, but there needs to be enough flexibility to make some changes down the road when what they thought about when they were alive isn't necessarily what's going to be in the best interest of that dynasty after they're gone 20, 30 years from now. And so those are some of the discussions that we do have and we do plan for individuals and for individual trustees and for individual grantors.
That's
I was
great,
gonna
Larry.
add to that.
So,
I was gonna
yeah,
add to
please
Larry. I can't, I mean, the number of clients that I have that first come and their first is, I don't want anyone to be able to sell anything after I'm dead. And I have to explain to them that you cannot just plainly disallow the sale of your real estate. We have to work out how this actually means on paper and what you are enforcing post death. Besides the fact that to some extent it's not even allowed, but it's about understanding what the goal is and then kind of explaining to the clients that you can't try to control from the grave, right? You have to have flexibility because at the end of the day, like you can't there things change and you want the beneficiaries to be able to live off of that to the extent they need to.
excellent. Those are great points, and
Definitely.
clarity around goals and flexibility and adaptability as well. And so that leads us to the next panelist. So I'm glad we got the technical difficulties covered, Steve. But Steve, you head up Northern Trust real estate practice, and you oversee a pretty diverse array of real estate types and trust dynamics. And acting as a corporate trustee role in managing real estate within a trust, it is really multifaceted and involves several important responsibilities. So can you explain to the audience kind of your day-to-day duties as a trustee in managing the real estate held by these trusts? And then for the audience's sake, we have real estate professionals across the board. Can you talk a little bit about the services you provide in-house and then what you typically outsource?
Sure. Thanks again for inviting me, and sorry for the technical hiccup earlier. I would describe the team that I oversee, which is a specialized commercial real estate practice that handles income producing properties nationwide. And we are a smaller group. We've got 11 people nationwide, but everyone really comes from the commercial real estate industry. So the best analogy I could describe our team is we're performing a similar function to the asset management department in a real estate investment firm. But we are doing so with full fiduciary duty. So we are conducting our asset reviews. We are working with committee structure to ensure compliance. We're doing our annual budgets, both in-house and along with third-party property managers. And then we're really focusing on documenting major decisions in a thorough way to support any type of transaction or property level decision that needs to be communicated to beneficiaries and also for our own files. But as a real estate asset manager, we will do some limited property management in-house. That's usually for more simplistic properties, single tenant net lease properties, some retail up to 4 units, some apartments up to 3 or 4 units. We'll handle that as a direct asset and property manager. But for more complicated assets, we are working with a lot of third parties in order to conduct our duties. And we're working with property managers. We almost always transact with a broker involved. We frequently use outside counsel to advise us on leases, lease disputes, lending, obviously acquisitions and dispositions as well. Many trusts require us to continue using the client's outside CPA. And so we do a lot of work with consultants. And then obviously we have a ton of property level vendors who we must engage as well, whether that's people who work on the property themselves or specialty contractors or consultants when we're trying to verify information or to get advice around a certain thing like environmental consultants. We've worked with roofing consultants. We've engaged construction managers for major improvements, things like that.
Excellent. Excellent. Thank you for highlighting those areas. It's I think it's important for the audience to understand the unique perspective from the corporate trustee world and the services that you provide. And so, diving into a topic that I think we'll go into a bit, but we could save any conversations around the depth of this topic for later. But I would like to discuss, Della, with you the topic of the planning process by which trustees are selected to oversee the responsibilities of a trust. So what considerations and criteria are individuals and families weighing when making this crucial decision? And why is trustee selection so significant in the estate planning process, particularly for trusts that own real estate?
Yeah, definitely. Peter had a couple slides on, the duty to inform, the duty to loyalty, and duty of care. These are all, of course, I'd say like the main overarching principles of being a fiduciary. So when you pick someone to be your trustee and to serve in that role, you really will need to have someone who possesses the characteristics to fulfill those legal duties. So if I was to, in the case of real estate, you're talking about a much more complicated plan and a much more complicated portfolio. So typically my clients, the people they choose are people who have the capability and willingness to stay up to date. They're willing to learn a little bit more about real estate and what that takes. They also understand, and I make sure that they are aware that sometimes it's a team. It might not be just the trustee himself or herself that needs to be worked. Oftentimes it involves getting other people and experts to come in and help to administrate that trust. And with that, I want to make sure that the trustee is someone who is a capable person. And maybe in my case, and maybe Larry and Steve will speak on this, oftentimes you name your family or your children who are the beneficiaries as the trustee once you pass away, once the grantor passes away. And in that case, it really does play into the capability of those beneficiaries to take on that role. I often have clients who the beneficiary might need someone to watch over them more so, and their spending and the way they make decisions might not be in the best interest of the trust assets. So it's critical and crucial for the grantor to understand that oftentimes the beneficiary themselves aren't the best person to play in this role. And then, of course, a consideration is the availability of the trustee to act. More often than not, I have people who name a bunch of people as the successor trustees, and you just go down this list, and like the next person says, I'm not willing to act. I'm not willing to act. And at the end of the day, like even the list of 3 or 4 people, you might have nobody who is willing to serve in that trustee role, because it really is, it is a responsibility and it is a big role. So I don't want to take too much more time. There's a lot that goes into picking a fiduciary, but I would say, you want to make sure that it's someone that the beneficiaries are going to rely on. It's not going to be any more conflicts of interest, and a professional. In the case of real estate, they should have some understanding of that portfolio.
Excellent. Yeah, and that leads me to my next question, which I'd like to pose to you, Della, first, and then to Steve. Oftentimes with the real estate within family trusts, you see co-trustees, a co-trustee, multiple trustees, and so maybe you can talk to the audience a little bit about why you might see the co-trustee role come into play, or co-trustees come into play with these trusts.
So there's different reasons people pick co-trustees. Sometimes they like to, pair a relative with a corporate trustee. And that serves the purpose of kind of having the opinions of both the person who knows the grantor very well, but also the professional help of a corporate trustee. Other reasons we often have co-trustees is because maybe someone has 2 kids and they want both their kids to have equal say as to what happens to assets. So they name them both. Also kind of, reduces the responsibility on one person to handle everything. Or I've had clients who they know one of these co-trustees has a lot more expertise in an area and the other one has a better understanding of, I don't know, taxes or what maybe, and they put them both together hoping that is a good situation for handling the estate. But with that said, the co-trustees also have their fair share of problems. Depending on how the trust is written, you can have language that requires both or more, however that is, to be unanimous agreeing on things. And that can be administratively a disaster. I mean, people can hold out on agreeing to certain things, and then lack of communication can come into it. But in general, it really is about understanding what the grantor wishes, and then implementing that and making sure that everyone is clear, and the rules as to how decisions are made are clearly stated in the trust to reduce the conflicts to the extent possible.
Excellent. And I think maybe expanding on that, Steve, I'm assuming, Northern Trust and your firm gets named as a co-trustee in some or many cases. Can you talk about how you operate in that role? I mean, there's variables, I'm sure, but maybe give the audience a little perspective on your role as a co-trustee.
Sure. With hundreds of assets under our area of responsibility, we have co-trustees in a number of situations. And usually these are very collaborative experiences where we are working hand in hand with the co-trustees, making sure that we're unanimous on the direction that we're going on a particular property. I think having a corporate trustee paired with either a private trustee or a family member can be really helpful, in that the corporate trustee has experience in being a trustee, and also has, in the case of our group, a really strong real estate background. So we can do a lot of the heavy lifting when it comes to a lease transaction or a sale transaction, because we're doing those kinds of transactions very frequently. We're very familiar with the process. So we can work with our co-trustees to ensure that they're comfortable with the way things are going, with the documents, with the terms and conditions of those documents, working through negotiations, often with outside counsel. And they can also tap into our resources for recommendations on vendors or third-party experts in order to gain a perspective on a certain aspect about a property. So that's really helpful. The other thing I'll say is, as a corporate trustee, it's also a private bank, working with us can give transparency to other family members who may be beneficiaries of the trust, who are not acting as co-trustee. So whereas the co-trustees are most knowledgeable about a certain situation and are communicating very frequently about a certain situation, there may be additional beneficiaries of that trust, whether they're siblings or grandchildren or even charities, who need to have information as well. And our system allows online access to view what's happening in these trust accounts. And they're able to see the activity that's happening in the trust account. They're able to have that transparency, which I think probably provides a strong level of confidence. One drawback, of course, as Della mentioned, is when a trust requires unanimity to make decisions. And often that can be challenging if a decision that needs to be made is controversial. There's a flip side to that, another way to look at it, because a trustee, a corporate trustee, is also very cognizant of risks that it is taking in its fiduciary capacity. And there are certain risks around transactions. There's risks around concentrations of assets in trusts and things like that. And sometimes having a co-trustee involved can alleviate a little bit of that risk because of the requirement to be unanimous. So it can cut both ways.
Excellent. Excellent. Yeah. And kind of jumping off with what Della was saying earlier about, not accepting the trustee appointment, Steve, in your case, do trustees have to accept every appointment? I know the answer is no on this, but the follow-up question is, what are some of the issues that might arise with regards to why a trustee doesn't accept an appointment with real estate? So what have you seen out there and the reasons why you as a corporate trustee might not accept the appointment?
Sure. Yeah. So any trustee can decline the appointment. And that's why when Della drafts these documents, there's usually 3 levels of successor trustees or more dictated in a particular trust document in case someone's unable or unwilling to act. When we're named in documents to act as a trustee, we go through a very rigorous acceptance process. And if anyone in the audience today has experience doing real estate acquisitions as an investor or working for an investment firm, you know how rigorous the research that's conducted during a due diligence process for a real estate acquisition is. And oftentimes we're called on to be the trustee. And when we're serving in that role, we're stepping into the landlord's shoes. So I draw that analogy to due diligence because that's really what we're doing. We're trying to understand as much about a property or a portfolio of properties as we can. So we're performing that similar function during our acceptance process. We're reviewing information about the property itself. What's the financial condition of the property? How is it performing? What is the actual physical condition of the property? What does it look like? We understand the tenancy, what capital improvements have been done, which capital improvements will be required. We look at the capital structure, equity and debt, co-owners, understand loan details, et cetera. So we're digging through all of this information, and we're trying to do it in a very short amount of time. Different trust companies have different approaches to their acceptance process and which aspects of either a trust asset or a trust itself that they would find suitable or unsuitable. I'm knowledgeable about certain aspects of property. Not every trust company is willing to accept property that has environmental contamination. Some trust companies are willing to take on environmental risk when there is sufficient liquidity to pay for it. There's other red flags that trust companies are concerned about at properties, like ongoing litigation about a property. It's very difficult to step into the role of the landlord when there's existing litigation that's happening or other disputes that are happening, like a lease dispute, a loan default, or even a pending transaction that it did not initiate, but by the virtue of it stepping into the trustee role would have to conclude. All of those things can complicate the matter. And then there is the issue of time. Oftentimes we're asked to be the trustee as a result of someone's death, and these assets are includable in their estate. And as Larry will tell you, the estate tax return needs to be filed within 9 months of someone's death, or it can be extended for 6 months longer. But if we're getting the phone call out of the blue that we've been named successor trustee because somebody declined and it's 5 months after somebody's passed away, we really only have 4 months to get our arms around the estate and file an initial return or file for an extension.
Excellent. Excellent. Thank you, Steve. And jumping over to Larry, Larry, you work with clients from an accounting perspective, I mean, for many, many years, and, you have your best practices with regards to accounting and financial strategies, particularly as it relates to real estate assets. So, as part of this succession plan, and maybe for our audience sake, with regards to financial and accounting best practices, what are some ways that you can ensure these real estate families can ensure there's a seamless transition to the fiduciary from a record standpoint and accounting standpoint?
Well, keeping accurate records and keeping accurate documentation obviously is very important. Oftentimes, things are in the head of the grantor and is not put down on paper, and there are napkin deals that have been consummated, and the trustee comes into that role and has no idea what took place, and you got to go through the cipher. And the human nature is when that person is gone and there's nothing in writing, somebody's going to contradict what is in place. And so our role is to make sure that things are properly documented, things have been properly reported over the life of the transaction, and that there is going to be seamless continuity in handling those transactions. It's very important, as Della has spoken about, is to have proper documentation for everything. And we work with the client, we work with the attorney to make sure that these elements are taken care of upfront, and we don't find ourselves in a post-test situation where people have no idea what's going on and we have to rehash things over again. So that's where we play a role in in continuing the activity and making sure it's seamless going down the road.
Excellent, excellent.
And
So
I would
preparation.
add,
Yeah, Della, please.
oh, I would add to that just something like, in my case, I have so many clients who think properties are in the trust, then they've never actually funded the trust. I
Yes.
just had it yesterday where I have a very close relative who was convinced that the house they owned was in their trust, and I looked it up and I was like, it's not actually. And so, it's about that funding process. When you're buying that real estate, at that time, it really is the best time to have the documents ready to make sure your assets can go directly in it, whether it's going to go in the trust, whether it's going to go into the LLC. It's that initial funding where it's the best time to make sure that the assets get funded, or else so often they get forgotten later on.
Let me add one other thing in the same vein of making sure things are properly titled. There are some significant tax consequences if title is not correct on debt. People seem to think that the easiest way is to hold title maybe as joint tenants, and with a surviving spouse, well, they're going to get that piece of property. It's easy. There are some significant tax consequences that need to be taken into account, and advising the client that, make sure that the proper title is maintained so that we don't have adverse tax consequences later on.
I think
with
that's-
that, there's also there's a lot of tax consequences with the LLC too, whether you created the LLC and then put it in, or you got the property and then you made the LLC. Just stuff like that where obviously, like, your average person might not understand the difference, but in the long run, when the initial owner passes away, can really cause reassessment issues in one versus the other.
And it can cause income tax consequences. Many wealthy families are using gifting strategies along with LLC interests. And when there's a death, and oftentimes there's a step up in tax basis upon someone passing, if the gift is made prior to their passing, there isn't a step up. And so there can be some confusion at that time about who's holding the gifted interest in the LLC and what the consequences are of an eventual sale of the underlying asset owned by that LLC.
Yeah, all of those are really important strings that I think we could do an individual webinar on, related to title, property taxes, and advanced tax planning strategies. So I'm sure we can we'll talk to the audience whether we want to go into detail on those, but those are really great points. Thank you all. So Larry, going back to your role as a trustee and a CPA, how do you really strike a balance between the financial objectives of the trust and the personal wishes of the estate holders and beneficiaries when making decisions about the real estate holdings? I know that relationship between trustee and beneficiaries is a unique one.
Well, clearly they're two different responsibilities, but in many respects intertwined. The trustee relationship is something that's developed over a period of time. And when a client names their CPA as a trustee, is because they have a tremendous trust in the individual, the integrity of the individual, and the ability of that individual to carry out their wishes. Many times there are beneficiaries that are in major conflict, and the trustee plays the role of putting these conflicts aside and making sure that the terms of the trust are followed, and those terms are the wishes of the grantor. And so, taking on the role of trustee, and when it comes down to real estate specifically, to make the decision, is holding on to that piece of real estate the right thing to do? Is there enough to provide the flow of income that is necessary for the beneficiary by holding on to that piece of real estate. Della touched upon the issue earlier, where there is a desire to keep the real estate going on, indefinitely, but liquidity may be a major issue. And if the real estate is not providing adequate cash flow, the appreciation and even after tax consequences in that real estate may dictate a sale in order to keep up with the required income distributions to the beneficiaries and to maintain the quote lifestyle that they had as defined sometimes in the trust agreement. They will, the grantor will ask that the fiduciary distribute enough money to the beneficiary to maintain the same lifestyle that they had during the lifetime of the trustee. We all know lifestyles change with age, and what was a robust travel plan at a younger age is a robust medical necessity at an older age. And so all these factors have to be taken into account in determining what assets are maintained, what assets are sold, and how you administer the trusts. And my role as a CPA and my role as a trustee, like I said earlier, very much intertwined, because the one side allows me the ability to make a lot of these decisions in determining what's best for the trust.
Excellent. Thank you, Larry. And I will say, I know we have a couple of questions on the panel. You can feel free to submit those questions through the Q&A chat, and then we will answer them at the end. We'll have a little bit of time to go into the Q&A at the end here. So Steve, I want to go to the same question for you. Balancing the objectives of your role as a trustee between the financial objectives and then the personal wishes of the estate holders and beneficiaries. How does that show up for you as the corporate trustee?
Well, Peter outlined the duties of a trustee, which are numerous, and those really guide all of our actions. But and I'll just contrast my comments to Larry's, which was, I'll speak a little bit more about the operation of a property. So practically speaking, we need to understand the confines under which we have to operate as a trustee by understanding the trust document itself. It's our governing instrument. And depending on the type of trust that owns the property, we've really got to analyze those terms in order to strike the balance. So for instance, a trust may require that all the net income of a trust be distributed to the beneficiaries. But if there is a trust-owned property that requires capital investment, like tenant improvements, leasing commissions, even a roof replacement, for example, there could be a sound rationale to build a reserve, either at the property level or at the trust level, in order to plan for those capital needs prior to the distribution of net income. And this is really important depending on the kind of trust. So oftentimes irrevocable trusts cannot have assets added to them. So you could, if you didn't have a reserve, you could be in a bind looking for sources of capital to fund those capital needs. And sometimes trustees will look at debt in order to fund those, but that can also create some challenges from a trust, a risk, and a tax perspective. So from an operations standpoint, understanding what the needs are from the trust it dictates how you can make reserves and plan for liquidity. And it really does come down to liquidity. I'll say another example comes to mind when a property is co-owned by multiple parties, or it's co-owned by several trusts for different beneficiaries. And especially around a sale decision, striking the balance between what the trust document says and what's happening at the property level is complicated because there's a lot of different outcomes that will happen to the different owners. They may have different bases in the property. The beneficiaries may have different income needs. There could be a requirement that the trust distributes a minimum percentage of assets on an annual basis, depending on the type of trust. And so how we approach that is we've got to understand the potential sale of that property by looking at it through multiple lenses. And we're going to look at what are the income consequences of a sale? What are the tax consequences of a sale? What happens to the net proceeds? And then not just analyze those, but it's a best practice in our world to also document that analysis and then work through our committee process to obtain approval for the best possible transaction.
Excellent. Excellent. Thank you, Steve. And I want to move this along to give the audience enough time to respond and go through some Q&A. But Della, I think your perspective on kind of balancing the role as a trustee and the objectives and the personal wishes of the beneficiaries is important. So I want you to kind of key in on this as well and give us a brief response on that.
I mean, I think I kind of touched on it a lot, which is you're dealing with people that might have emotional investment in something against a fiduciary who has a complete obligation to growing and a financial goal for the estate portfolio. So the real way for me to work on that is to kind of like communicate between all the parties, understand the underlying issues and understand the underlying goals. For some clients, they want to make sure they have the largest portfolio possible to preserve for generations to come. Others, it's about avoiding taxes to the extent possible. Others, it's about how much can I give to the charity and how much is left over in that for my charitable contributions and where I want to how my legacy will be. So it really is spending the initial time understanding those goals. And my goal essentially is to make someone like Steve's good job much easier by having certain decisions already decided and provided for in this blueprint that is the trust. And so long as it's very clear and concise and able to accomplish those goals properly, it will reduce any type of conflict and to the extent possible, make it easier for those fiduciaries to play those roles.
And I think those are really great points and probably worth keying in on that, not every family has the same goals with regards to their real estate or their objectives with their legacy. So I think that's an important element to key in on. So I think a topic that I know is going to be near and dear to the audience's heart around real estate is, we obviously have a shifting marketplace. We have a shifting economy. Things have changed over the past year plus with rising interest rates and declining values. So, Steve, I'd love to hear your perspective and insight on, as a corporate trustee, on managing, multiple asset types and locations across your portfolio. What are the real estate trends that you're seeing across your portfolio right now? And how have the changes in the economy affected or not affected some of those trends that you've seen over the past year or so?
Yeah, absolutely. The market has changed right before our eyes. I would say in general, we're seeing a pretty significant impact from the investment sales side. The sales market in LA County is down tremendously year over year. That's causing appraisals to be a little bit lower than they were a couple of years ago. And so valuations are different. I'd say the leasing market has changed a lot too. Obviously, we're seeing most headlines written about what's happening in the office market and how challenges are occurring there and vacancies are staying intact for extended period of time. But it is really dependent on the property type and also the geography. So we can't say that, industrial remains white hot like it was a year ago when we have industrial in 6 different submarkets. Each one is going to have a different result. But yeah, generally across the board, we do have higher vacancies, and we do have lower values, mainly as a result of a slight uptick in cap rates. And I think a lot of people try to draw the correlation between interest rates and cap rates, but there's also an element to cap rates which is driven by buyer demand. And with higher interest rates, some buyers have decided to sit on the sidelines. So there's fewer offers for when a property is listed for sale.
Excellent. And I would assume, and you could correct me if I'm wrong, that you're not realizing or seeing as many 1031 exchanges either, or handling those from the corporate trustee level as well.
Well, it's interesting. A lot of times the decision to sell as a corporate trustee is not necessarily dictated by some element of performance in a property as much as it's dictated by a certain date that's in the trust document, which triggers the necessity for a sale or a distribution of liquid assets. So the 1031 world is one that we do discuss a lot with clients, and those clients who are in the process of selling assets who wish to defer the recognition of gain on those sales are actively looking. And my understanding is that volumes in that world are lower than they were in the last 3 years. And that's affected a lot of the replacement properties that were popular, both STNLs, DSTs, other kinds of real estate assets that are popular in 1031 exchanges as people are selling more active, time-consuming properties and wanting to get into properties that are maybe less time-consuming. So that's absolutely a factor in what we're seeing in the investment sales world right now.
Excellent. Excellent. Well, I want to, Larry, do you want to key in on any of those aspects as, you know, coming from your perspective on the real estate, kind of the real estate environment right now, how that's affecting decision-making on your side of the equation, either as a trustee, accountant, or a real estate investor yourself? And then from there, I want to go really quickly into our attendee questions.
Well, clearly the market has changed in, I'd say probably in the last year and not much longer than that. And it has affected decisions, investment decision, sales decision, acquisition decision. What we were willing to pay for a piece of property a year ago or a little over a year ago is very different than what we're willing to pay today. Interest rates have played a tremendous role in those decisions. So much of the activity is slowed down tremendously, and hold on to the assets if you're a seller, and if you're an acquirer, if there's a good opportunity out there at a good rate, and you know, evaluating what the financing cost is going to be and what the cap rate is going to be, part and parcel in making that decision. So we are in a somewhat of a hold position until things get normalized again. And we manage our real estate portfolio that way. You know, what got started, we continue, but new projects are on hold for now.
Excellent. Excellent. Okay. So I want to go into, give time for a little bit of time for Q&A, and then we have a poll to do at the end here. So stick with us if you can. We'll go through these relatively quickly. So this is a question from Nataya. And I believe you potentially mean the property manager, but could the trusted manager be appointed? How much should the manager be compensated for the duty? Well, maybe the meaning of this is the trustee and the compensation structure. So maybe Steve, can you talk maybe at a high level about compensation structure as a trustee, corporate trustee?
Sure.
I know that's a broader topic, but that's
all right. In general, trustees are compensated. Their compensation has to be fair and reasonable, and there is a standard by which many trustees are compensated as a percentage of the overall value of the assets in a trust. And it's a low percentage, and it varies by trust company, but that's typically how it's done. It's the value of the assets of the trust, which are verified either in real time for liquid securities or at least annually for more specialty type assets, are added up, and fees are calculated as a result.
And that's the gross values of the real estate?
Well, I thought you wanted to say high level. Sometimes it is the gross values on more complicated assets. Some trust companies will calculate the value of an asset. They may choose, depending on their policies, to apply fractional interest discounts, let's say, for instance, on an illiquid entity or something like that, if it makes sense.
Okay, excellent. Thank you, Steve. Next question, what do I need to do to work with a fiduciary? Will the CCIM designation help? I can answer that. I would say, the CCIM designation we have, from my perspective, it does help. I think it helps it helps add credibility to, your background and your experience in providing, trusted advisory services to a fiduciary. But I can, Larry or Steve, I know maybe one of you want to talk about your experience in working with CCIMs versus non-CCIMs. Anything you want to add to that?
I think the relationship is based on an individual level, Jeff, and the very, often very quickly you can determine the competency level of the individual, whether the initials are there or not.
Yeah.
Clearly it adds credibility, and I learned a long time ago, initials after somebody's name doesn't mean they're competent. The individual interaction is what determines whether you're dealing in a competent situation or so forth. So the most important thing is to work with people who are knowledgeable in what you're trying to accomplish, and get you the best results that you're ultimately looking to seek for.
Excellent. This next question is for Steve. This is from Doug. That last question is from Alfredo. Does Northern Trust have a formal process for identifying, vetting, and ultimately selecting the most qualified brokers for a transaction?
Yeah, we do. We are most likely interviewing 2 to 4 brokers for a typical sale transaction. I think geography matters in this instance. We're not going to use someone out of state to sell a property in another state, for instance. So we do want to ensure that the folks who we are interviewing are active in the particular market that where the property is located. There is also an important aspect of choosing which brokers to interview in verifying that they have experience in the property type and in the transaction value range that you're working on. So those kinds of general things are guidelines that we ensure are a minimum on verifying the brokers who we're going to interview for a transaction. And then ultimately selecting a broker is really going to depend on their approach to the property, the insights that they're able to provide, understanding their marketing process, and some of the tactics they use to attract interest in the property. Those are all the things that we find compelling when we're interviewing brokers.
Excellent. Thank you, Steve. David Hewen asked about contact information for each of the speakers. If there's further questions, David, yeah, I'm imagining that we can give out contact information, but I need to get confirmation from each of the panelists, but I'm assuming that won't be a problem. The next one is, what is the normal, this is the last one, what is the normal percentage for assets, like for a corporate trustee, for assets valued between $5 and $10 million? That's a very specific question, Steve.
Well, I gave a general answer.
Yeah.
And I know that Larry has also acted as a private trustee, and I don't know if it would be valuable for him to provide a view on fees there either, but do you want to go,
Generally,
Larry?
Sure. Generally, in a trust of that size, it's around 1% of the value on an annual basis. You know, if the smaller the trust, the more work there is, the more the fees will be. But on a $5 to $10 million, it's usually 1% of the market value. And unlike corporate trustees that evaluate and value real estate on an annual basis, or maybe on a biannual basis, I don't do that. And generally that's to the benefit of the beneficiaries, because I don't take the appreciation into account for an extended period of time. So it's a question of what type of assets you're working with, and the amount of time and the size. You know, sometimes there are extraordinary services, and there's the ability to charge some additional money in the event of an extraordinary transaction.
Excellent. Thank you, Larry. Well, I want to close out this panel by giving a sincere thank you to all of our panelists, Larry Klumek, Della Pekar, Steve Todd, and Peter Lawson, my partner in crime. Really appreciate all of you coming on. I thought it was really informative, and we're looking forward to pulling on some threads with some of these specific topics in the new year. And to that extent, I do want to do a really quick poll with the audience here. So if DJ, if you can put up the poll about some topics that, you know, we aim to cover or would like to cover. We're going to give you a minute to respond to the poll question about, you know, which two topics. Well, actually, this looks like we're only doing one. So you would like to cover. It looks like you only have the ability to answer one, but if you could answer the question, and then we'll close it out and see which topics resonate most with the audience. We'll give it another minute because we're a little behind, or another second because we're a little behind. Okay, so DJ, did we get all the responses in? Yes, no, maybe so. I know that we were going to put up the poll and see which. Let's see if we can do that. Maybe not. Oh, there we go.
There we go.
There we go. Okay. All right. So it looks like fiduciaries and asset property management, earning real estate business from fiduciaries, fiduciary selection process got 30%, fiduciaries and real estate transactions got 30%, and then property taxes and reassessment implications got 10. Okay, good. So that gives us some food for thought and feedback for the new year. And really appreciate everyone attending. Again, if you want to get involved with the Fiduciary Committee, I would highly encourage you to sign up as a CCIM Los Angeles member so that you can get access to all of our education. And again, I want to thank you all for attending, and we are looking forward to working with you in the new year. Thank you all. Thanks to the panelists. Take care.
Jeff. Thank you all. Bye-bye.
Bye.
Bye.
Thank you.